Happy summer, everybody. Chad Parmenter, Kyle Temple, and Maiko Santos here from Mirus Planning. We are a little late on our second quarter call. We apologize, but we're kind of in the middle of summer, and we've got a couple announcements to make on this call, and it'll probably explain why we're a little bit late on July 30th. It has not been because we've been messing around on our summer plans, although we're looking forward to taking a little time off in August. You may have seen that note from us this morning, but we welcome you all. We're going to cover a couple items. Kyle, if you want to push me to the next slide here, we're just going to jump into a couple housekeeping items, and Kyle's going to do his normal technical side of money, financial market updates, utilizing a lot of our data from JP Morgan and Capital Group and others. And then just kind of catch you up on what's going on around here. The big news, which we have really not sent any notices out yet, is that we have been in the process of moving. We still have an office in Kirkland. Our lease is up in November. However, we did decide to move our space down to Bellevue for several reasons. We needed a little bit more space, and we just kind of wanted to change things up. And for me personally, it's a little bit closer to home from a commute standpoint, but we are excited to announce that we have landed. We are officially here in our Bellevue office, and we're looking forward to hopefully seeing people here. We've seen several folks already here in our office, and we expect to see more of you coming up. Kyle noted on this slide that we are going to do an open house before year end. It may be in the fall, it may be closer to the holidays. We're not exactly sure how that's going to work out, but just an FYI that we'd love to have people come on by, and we'll probably do something as a group later this year. Also, just a friendly reminder, we are still not working on Fridays, and that will keep going all the way through the end of August. Not until once we're back for Labor Day weekend will we be working again on Fridays. So it's been working out pretty well, I think, for most people. But we just want to make sure that everybody understands that if you do send us something on a Thursday night, we may not be getting back to you until Monday. All right. All right. Next, Kyle is going to jump right in and talk technical side of money, and I'll just be quiet.
Yep. So yeah, we're going to just quickly brief what took place in the second quarter of financial markets, and also just kind of take a look at what's taken place year to date. Quickly, just wanted to kind of address some headlines. As of May, we've got a new Fed chair, Kevin Warsh, and he has been a little bit more hawkish, which essentially means the Fed is going to be a little bit more aggressive in terms of using interest rate policy to combat things like inflation. So when we had our first quarter call, for example, the financial markets were actually expecting rate cuts before the end of the year. 3 months later now, we are actually kind of in an environment that is expecting rate hikes before our year end. So we're going to take a little deeper dive into that here in a second. Also, the conflict with Iran continues to be an on again, off again. Essentially every day there's a new headline. We've got a peace treaty. We're back in conflict. This has created tremendous oil price volatility. And then Q1, we also saw financial market volatility and kind of stocks and bonds. But as our far right-hand note here notes, we actually had the strongest quarter in the second quarter of this year. Best quarter since Q2 of 2020 when we were coming out of the COVID crisis. So been a really volatile year, a lot of headline risk, again, with the Iran conflict, with interest rates, but corporate earnings remain robust, and there continues to be a lot of euphoria and excitement around ultimately the AI advancements that continue to come about over the last 12 months from these AI product labs. So we're going to take a quick dive right into our very first chart. We look at this one essentially every quarter that we connect. Just an overview of the S&P 500, the U.S. stock market benchmark, kind of where we're at today. We're up 8% year to date. It's been a good, strong second quarter. You add the weak first quarter together, and we're still at a pretty nice clip of 8% a year, or 8% through the first 6 months. We averaged 9% on a long-term average, so we're actually almost at annual averages through the first 6 months of the year. The red dots, however, denote the downside volatility that we've experienced in financial markets. And at one point, again, doesn't seem like a far away point at this point, but financial markets were actually down over 9% at one point in Q1. And again, we've had a really, really sharp rally in the second quarter. So continues to be a strong theme of positive financial market returns, which we want to see is a good thing for client portfolios. And really that's on the back of what has been strong corporate earnings growth. So we've hit new all-time highs in financial markets. People really kind of think that is a good time to, exit stock market portfolios, but really why you are invested in stock market portfolios in the first place is long-term corporate earnings growth. And that's what this chart is taking a look at, is really how much earnings has the S&P 500 generated as an index. You're going to see, for example, we had a recession during 2020. That was the COVID conflict. Had a nice recovery in 2021, but then we're actually kind of stagnant in regards to corporate earnings over the last several years. But in the last 12 to 24 months, we've actually kind of seen a ramp up in corporate earnings to where we've had strong growth so far year to date. You're going to see, again, we're projected to have record corporate earnings this year. And analysts, again, expect that trend to continue into next year. So when you ask why are portfolios up, 8 to 10% this year, despite a lot of, the conflict and the headline risk, it's because at the end of the day, U.S. corporations are really healthy and they're driving profits to the bottom line, which ultimately drives stock prices over the long term. So this is one of those things that we can continue to kind of look at and make sure that clients are getting good value in terms of, what they are paying for these stocks. But again, it's been a pretty healthy start to the year. This also shows that it's not just U.S. stocks doing good. Actually, international stocks and emerging market stocks are actually off to a better start this year. This actually continues a trend we saw in 2025. We, again, are big believers in global diversification here, and that continues to pay off. These international indexes don't have as much tech exposure as well, so they're a little bit more diversified than just the pure S&P 500, which we're going to go into this next slide. The S&P 500 at the end of the day remains a highly concentrated index. 10 companies at one point made over 40% of the index. People, again, they hear S&P 500, they think they're very well diversified across 500 companies. However, just 10 take up a big chunk of that index there. And this is a pretty unique phenomenon. Again, when we look at a historical context, historically, we're closer to kind of the 20 to 25% average for the weightings of these top 10 stocks. Again, we've gotten over 40. So this is just another trend that we continue to keep our eye on and ensuring that clients are just not too exposed to one specific sector, or in this case, 10 specific tech companies.
And to refresh everybody's memory, if we go back to this slide real quick, the S&P 500 is weighted based upon market capitalization. So these are the biggest companies in the world, which you hear about all the time, like Apple and Amazon and so forth. So we've been talking to clients for several years that this trend of those types of companies, betting on AI and all these other things are going to, ultimately get to a point where they're kind of expensive. And we've actually started seeing that a little bit. Kyle's probably going to talk about that here in a minute, but we've definitely seen a pullback in that space this year. So just something to remind everyone of, and we've been talking about this for a while, going back to those international numbers that Kyle noted earlier. There's some real opportunities that are not in the news. And so it's just something to pay attention to. And when we say opportunities, we're looking for value. We're talking about things that are investments in companies that are generating good earnings for their shareholders and for themselves, but also being in a position where the cost of those companies are not expensive like some of these tech-oriented ones that are currently dominating that S&P 500. To Kyle's point.
Yep, great point there. One thing we want to flip to is on the fixed income side. This is more green bucket exposure, so kind of opposite of the stock market. This is designed to be the buoy of the portfolios. If you look at just your bond prices, you're actually going to see the bond prices have actually gone down so far this year, because that is the teeter-totter effect. We've seen a slight rise in interest rates, which means existing bond prices go down. So if you look at just the bond values, your bonds are actually negative in terms of return for the year, but you also have to factor in the interest income that you are getting on a monthly basis from those bonds. That ultimately factors in total return. And so when you factor in the interest income earned on these bonds, we're essentially flat through the first 6 months of the year. Because again, we've had that kind of rising interest rate environment. That is good news for people that stick with it and for people adding new money, because going forward, new interest rates right now are actually just about 5%. So we're able to go get kind of 5% average annual returns, lock those in for the duration of these bond portfolios, which is typically 5 to 7 years. And again, if you just hold on to those bonds, collect your income, we're expecting about 5% kind of forward returns out of core bonds, which is a really healthy number for, especially for conservative oriented investors. Again, pre-COVID, this number was say 1 or 2% annualized returns. So still a really healthy market for fixed income investors. It can be frustrating when interest rates are going up. But again, you just have to be patient with it, and you will eventually be rewarded with those higher rates as your interest income starts flowing back in.
And generally speaking, can we go back to that real quick? This is the other thing. So a lot of times you'll look at your statement, you'll look at it and say, wow, I'm down in my bond portfolio. This is just using the Vanguard Total Bond Index as an example. We have bond portfolios that are doing better than this, but just use this as an example. And you say, I didn't make any money. And potentially that is true when you take into account price and income. Well, why do you own bonds? We own bonds to reduce volatility, in our opinion. This is our opinion. Not everybody that believes this, but we own bonds and portfolios to reduce that volatility, sleep at night money, as well as provide cash flow. So in most of the portfolios that we design and utilize with clients, the cash flow that these bonds are producing is getting paid to cash. It's getting put into your money market account or wherever it is, and then can subsequently be used to live on. Maybe the bond prices are going down a little bit, but again, we feel like that sort of stabilizes, and we feel like the total return over the course of 10 to Kyle's point, 10 to 20 years is in that 5% sort of range right now, potentially even higher if this war kind of gets settled out. Inflation starts coming down and the Fed has the opportunity to start lowering interest rates, which to Kyle's point earlier this year, we didn't expect Iran to happen. Earlier this year, we thought we'd have 2 to 3 interest rate decreases by the Fed. So when that happens, what does that mean? The bonds you already own are actually going to be valued at a higher price when interest rates come down. So we're thinking about this in a more of a longer term framework, but just kind of an FYI, that's how bonds work. Interest rates go up, bond prices can come down, but you're getting a higher income from those bonds. So it's just stuff that you want to kind of play around with and think about.
Yep, and you can actually see that in the return characteristics at the beginning of the year. Bonds actually rallied. This is the market expecting interest rate cuts. And then at the end of February, we got in the conflict with Iran, and then that essentially completely reversed. The market was no longer expecting those interest rate cuts. So this is a kind of a volatile change that's changing week by week. But again, going forward, we think the opportunity set is very healthy for fixed income investors.
And that price on March 2nd or wherever that was, where we were at bonds at 1.8%, that's not because those bonds are all of a sudden spinning off, 8 to 10% in terms of income. That was more because of the price of the bonds going up, because the thought was interest rates were coming down. You're still getting the same coupon either way. And so that's what you have to remember. And that's really one of the fundamental reasons why we own them in the first place. They're not exciting, although they're probably more exciting than we'd like right now. They were really exciting in 2022 when interest rates went up 5%. We don't think that's going to happen. And we're actually at a fairly stable kind of price range right now and interest rate range. Remember, 2022, we went essentially from 0 up to 5%. So that was significant. Well, there you go.
Yep.
Speak of the devil.
Yep, that's our next chart. Just again, historical perspective of interest rate policy. We were at essentially a 0 rate during COVID, and then we went from 0 to 5 in the most rapid fashion in the history of financial markets. We've reduced rates a bit from those high levels, and so we're kind of in this kind of middle range here. What's nice about this chart here is these green diamonds kind of show where the financial markets currently expect interest rates to go. This is where we're at today. So this is where financial markets are pricing that increase in interest rates over the next 6 to 12 months. When we had the call 3 months ago, those diamonds are actually below this number. And that's actually what this gray bar represents, is just the range of expectations year to date. So 3 months ago when we had our webinar, we were expecting rate cuts. We are now expecting rate hikes. Realistically, we'll probably be talking to you guys in 3 to 6 months, and we'll still likely be in this range, barring any crazy new headline news from the conflict overseas. So but again, good time to put cash to work. If you have excess cash at the bank, great time to start locking in some CDs right now over 4%, because we do expect, say, 2 or 3 years from now, this probably be closer to around that low 3% range, rather than over 4. So good time to put some cash to work right now. Just a quick inflation update. Again, we talked right as this conflict in Iran was popping off on our Q1 call. We didn't know exactly how bad it would impact inflation, but we were pretty positive it would, to a somewhat negative extent. That's what this graph is showing. Over the last several months, we've seen a bit of an increase in inflation. That's essentially primarily due to energy costs. Oil and gas prices are going up. That trickles through the rest of the economy. Cost of goods and services go up as a result of that. So again, 3.5 is still nothing close than what we saw as kind of that COVID heat up 2021, 2022. But that 3.5 is definitely higher than what the Fed wants to see right now. And that's, again, why interest rates are expected to rise at least a little bit here in the next couple months. This is a cool, again, just really great research that the JP Morgan team does, taking a look at recent gas price spikes in a historical perspective. So this is definitely the highest gas price we've seen since 2022. Not quite as bad as when the national average actually hit over $5. Not to say, again, the conflict's over and we can't get there, but this price spike has been at least relatively we've seen this in the recent past. One reason the economy is actually performing real well right now, despite these higher gas prices, is that we are net exporters of energy at this point. That simply was not the case, definitely back in the 70s when we had the gas prices. Rising oil prices was very detrimental to the US economy, as we are importing a lot of oil and gas into the country, but we are essentially a little bit more of an energy independent standpoint, to where these rising gas prices still impact the economy, just not nearly as much as they used to in decades past. And then this really just goes to show that the lower income households do face the brunt of these increased prices there. And that can definitely impact the economy. Just because certain people are able to stomach these increases in prices doesn't mean everyone is. And that does ultimately trickle into demand in the economy. So just things that we continue to keep our eye on here. Last but not least, diversification benefits. The longer you give yourself in financial markets, the better your experience is going to be. Looking at portfolios on a daily or weekly basis is simply a recipe for unneeded stress. Financial markets are going to do what they do. They're going to go up certain months. They're going to go down certain months. We don't have a crystal ball to predict when that's going to happen, but again, it's our job to ensure that client portfolios are properly allocated to navigate all potential financial market environments. And that's, again, what we really strive to do here at Mirus. But again, when you give yourself a longer time horizon and a diversified portfolio, you really, really give yourself much, much better odds of success and positive returns in your portfolios. And with that, I'm going to kick it back to Chad.
All right, thanks, Kyle. That was great. I think you probably didn't expect us to talk about bonds as much as we did today, but it actually is somewhat fun for us to kind of explain the bond market at times. So some more housekeeping real quick. We do have the Alzheimer's Walk, our 10th annual Alzheimer's Walk. We've raised, with your help as clients and colleagues, over $125,000 to try to benefit Alzheimer's research through the Alzheimer's Association. And we've got that walk coming up on October 3rd. It's just we're going to be sending out a note, I believe, on Monday for people to be able to register. If you can't make the walk, that's okay, but we would love to have your support. We continue to believe that's a big issue that unfortunately many of our families have had to navigate, and we just think there's an opportunity for us to help if we can. Again, reminder about our upcoming limited operations that we sent out a note about this morning. Kyle and I will both be out of town. We're not traveling together. Kyle's going to be heading to Canada and then over to Idaho for a wedding. And I've got a little endurance race out in Colorado that I'm going to be participating in. So we're going to be gone, but guess who is in charge? Maiko Santos, and we think he's in charge every day anyway. So let's get real. He'll take care of you, and he takes care of us, and we know you're in good hands. But if you need us in the meantime, before we take off, we'll be around all next week, except for Friday. And then finally, we are going to be getting going on our planning reviews beginning in September, our normal kind of cadence of the year. We'll talk some tax planning and just catching up with all of you when and if needed, beginning in September all the way through the end of the year. So that's always our push for the year in terms of just checking in. I'll give you a heads up on that. Our communication, we talk about this all the time, but repetition is the mother of skill. Our text number goes to all of us, 425-250-9711. If that's how you'd like to communicate, send us a note. We're not going to send you any kind of advice or guidance using that text thread, but it's a great way to check in with us if you need to get on our calendar. Team email. This is an email. If you send a note to team@mirusplanning.com, it goes to all of us as well. So I'd highly encourage people to utilize that as a way to connect. And then we have one voicemail box. Understand when you leave a message for us, we all get it. And again, it's so that I'm not a bottleneck, or Kyle's not a bottleneck, or Maiko's not a bottleneck. If you leave us a voicemail message, even if you call my extension, it's going to be in the general voicemail box. And that's for a reason. So somebody's going to get back to you. Below there, we did make a note. We used to have a PO box for our mailing. Now we actually have the mail, the person from the USPS, they actually deliver the mail in person by hand to our office suite. It's fantastic. Old school. It's really nice. So our mailing address is 11911 Northeast First Street, Suite 305. We're in the midst of updating our website, doing a lot of different things right now this summer, taking advantage of a little bit of a quieter time frame, although it frankly hasn't been that quiet. But that's what we're going to be doing. So just kind of an update on that. If you send us mail, just send it to our physical address. Just again, we will always end this way. We really appreciate you all choosing to work with us or ponder considering working with us. And we love working with folks who are introduced to us by either happy clients or collaborative professionals. That is the only way we'll be working with new people going forward. We tend to be introduced to 20 to 40 folks a year. Not everybody's a fit, and that's okay. And we want to make sure that everybody understands we're going to make sure that people find a home if they are not a fit for us. You all know, I think by now, that our specialty is where we shine, I believe, is when we're dealing with big life transitions for people, and people are navigating, whether it's a loss of a loved one or a divorce or the sale of a business or retiring or being retired and thinking about transitioning with regard to someone's estate and all that type of work. But that's our job, is hopefully to make your life easier. So we appreciate you. Yeah, this is just a description of typically who our most satisfied clients are. Most people want to have a relationship. That's important to us as well. Want to have planning that's proactive and adaptive. We like to balance logic with emotions. We talk about the human side of money and the technical side of money all the time. We even talked about it today. But at the end of the day, people who care about others care about their future and values, and it's not just about the money. And view us as their guide. Because at the end of the day, if we can't help people kind of navigate their journey, then that doesn't make a lot of sense for us to be in that spot. Method, this is just a friendly reminder. We will not take on anyone as a new client who just wants to hand over money to us. And by the way, it's not a requirement either. A lot of people do hire us on a consulting basis, but we spend an inordinate amount of time making sure we're a fit for somebody who's introduced. Their needs, our services, personalities, expectations, what the engagement looks like. But that engagement is generally a planning only engagement when we're working with people. And if it turns out that planning and design and blueprinting, where we're analyzing their current status, helping stress test and then optimize a strategy and helping them implement some of that strategy, if it turns out they'd like us to help take over investment assets and have an ongoing relationship, that's something that we discuss on a secondary basis. This first basis, the blueprinting, is what it's all about for us. When we are engaged with a new client. But when we are introduced to somebody, just understand we're not going to strong arm them into becoming a client of Mirus Planning. Our job is to see if we're a fit. And if we're not a fit, find a better landing spot for them. And make sure that whoever did introduce us understands kind of where things are. I'm not going to share specific information. We're obviously confidential about all these things, but letting you know that we've either been able to help somebody or we haven't been able to help, and potentially why. But always making sure that everybody's taken care of. Last but not least, it's still summertime. I hear for Seafair, we're going to have rain on Saturday up here in Seattle, which is an unusual event. Evidently, it hasn't happened since 2008 on Seafair, but it's still summer, right? And we hope everybody is enjoying summer. Kyle, Maiko, do you guys have anything else to share?
Nope. I just want to say it's been a fun time getting moved into the new office. We look forward to having everyone come check out the new space. Nice, convenient parking, lots of local spots to come eat after you see us. So, yeah, we're really excited for this next chapter here on Mirus Planning.
Yeah, and I would say if anybody's familiar with Bellevue, which I'm sure most of you are, we are just across the street from the Bellevue Botanical Gardens, which is on the east side of 405. So we're kind of in southeast Bellevue. So we're not in downtown Bellevue, but we're kind of up on the hill. And it's nice and quiet up here. Our air conditioning works great. We have good lighting. We're very excited to be here. So anyway, we look forward to seeing y'all, and hopefully this was useful. And we appreciate you taking the time to hear about what's going on in Mirus and hear what's going on in the world. So thank you very much. Enjoy the summer. We'll talk to you in the fall.
Thanks, everyone.
Bye,
See ya.
everyone.
Bye-bye.